All right, let's jump right in. Today we are unlocking a secret that, it really separates the folks who are just wealthy from the true tycoons. It's this powerful strategy for getting cash from your assets without ever having to sell them. So how does that even work? Let's find out.
This one sentence, it really gets to the heart of everything we're talking about today. And it's not just some catchy phrase. It's a fundamental shift in how you think about your money. It's the difference between slowly chipping away at your nest egg versus using that exact same nest egg to create cash flow while it keeps on growing.
Now I get it. This whole idea can feel a little, well, backwards at first, and it creates a huge mental roadblock for a lot of investors. So to really get to the bottom of it, let's look at a real-world question that perfectly captures where people get stuck.
Okay, this right here is the puzzle we need to solve. So you've got $1 million portfolio. You want to borrow $20,000 a year against it to live on. And the loan has a 2% interest rate. The question is simple, but it's so important. Does that 2% interest, which comes out to $400, does that get taken out of the 20 grand you get to spend? It seems like a math problem, but really, the answer unlocks a whole new philosophy about wealth.
So let's solve this mystery once and for all. If that $400 in interest doesn't come out of your spending money, then where in the world does it come from? The answer is the key to this entire strategy.
And here it is. The first part of that big aha moment. No, the interest is not taken out of the money you've borrowed to live on. Your cash flow, the money you plan to spend, stays exactly the same. That is the first crucial piece of this whole puzzle.
And what's really interesting is just how simple the mechanics are. So in year one, you borrow your $20,000. Over the year, that loan racks up $400 in interest. But, and here's the magic, instead of you paying that $400, it just gets rolled into the loan. So your new loan total for year two is $20,400. But you still get your full $20,000 to spend.
So the bottom line is you're not paying the interest out of your pocket at all. You're just borrowing a tiny bit more to cover it. Your lifestyle doesn't change, your cash flow is exactly what you planned, and the whole system works by just slightly increasing your debt. A debt that, by the way, is still just a tiny fraction of your growing assets.
And this, right here, brings us to the most important takeaway of all. This strategy, it's less about the numbers and way more about a complete shift in your mindset. You're moving from thinking like someone who spends their wealth to someone who leverages it.
This slide lays out the difference perfectly. The wealthy person sells their assets to get cash. It works, sure, but their portfolio gets smaller and smaller over time. But the tycoon, they pledge those same assets as collateral. They get the cash they need, but the original assets, the golden goose, if you will, they stay put, continuing to grow and compound year after year.
So, you might be asking, if this is so great, why isn't everybody doing it? Well, it really boils down to one word: patience. This is not a get-rich-quick scheme, not at all. It's a strategy that only becomes truly powerful after you've patiently waited for your assets to grow to a significant size. You gotta be willing to play the long game.
Of course, to pull this off correctly and, more importantly, safely, you have to follow a few simple, non-negotiable rules. So let's break down the 3 core principles of smart pledging.
Okay, number 1, roll it in. We just covered this. The interest gets rolled into the loan. You don't pay it from your cash flow. Simple. Number 2, and this one is absolutely crucial, stay safe. This isn't about being reckless. It's about keeping your borrowing way low compared to your assets. And number 3, preserve the core asset. The entire goal here is to get cash without having to sell and disrupt that beautiful long-term compounding of your portfolio.
And on that point of staying safe, the guideline is very clear. A common rule of thumb is to keep your total loan-to-value ratio well below 30%. This isn't about maxing out your credit line. It's about using a small, conservative amount of leverage to give yourself liquidity while having a massive cushion to protect you from any market downturns.
When you put all these pieces together, the mechanics, the mindset, the safety rules, you start to realize this isn't just some clever financial tactic. It's really the result of a deeper wisdom about how money and time work together.
This quote says it all, and it's from the very student whose question kicked this whole thing off. Once they understood how it worked, they realized it wasn't about taking on risk. It was the exact opposite. It was the reward for years of discipline and patience. It really is the fruit of waiting.
And so that leaves us with one final big question to think about. A question for you. Is your financial strategy set up so your assets are truly working for you
growing and providing cash at the same time? Or are you still working for your money, forced to sell off pieces of your future just to live today? The answer to that could be the key to unlocking a whole new level of financial freedom.